More money making. Today I want to talk about the simplest investment portfolio available, which is to invest in a single fund called a global multi-asset fund. So let's go over a selection of them, while also discussing the important topic of risk tolerance, as well as a couple of more minor ones, such as home bias. As always, if you like what you're watching, please destroy the like and subscribe buttons and notification bell for the YouTube algorithm. A good multi-asset fund of funds contains several index trackers, offering you an instant, globally diversified portfolio with equities covering the world's major stock markets, as well as bonds and sometimes property, gold, cash, and more. Since you only own one fund, once you've chosen your multi-asset fund, you don't have to worry about rebalancing, which is the act of selling some of one fund and then using the proceeds to buy some of another fund. For example, let's assume you set up a two-fund portfolio of global equities and global bonds and decided that, according to your risk tolerance, which we'll discuss later, that you wish to hold 80% of your portfolio in equities and 20% in bonds, so you start out with that initially. But now let's assume that after a year, equities have gone up a lot more than bonds, so they're now 90% of your portfolio. So, to return to your desired proportions, you would need to sell some of your equities and buy more bonds. However, if you held your money in a multi-asset fund with this allocation, such as Vanguard LifeStrategy 80, the fund will automatically rebalance without the individual investor having to do anything. And even with a small investment, investors can get a diversified portfolio consisting of equities, bonds, and property, whereas some funds have minimum investment thresholds that would exclude small investors. Theoretically, you also get an additional layer of due diligence and protection, as the managers of the underlying funds have already conducted research of the underlying investments, and the multi-asset fund manager will do the same. A disadvantage, on the other hand, is that you'll probably pay slightly more than you would to buy each fund individually, particularly for an active multi-asset fund, which we'll discuss more later. Let's discuss a few of the multi-asset funds available to UK investors, starting with Vanguard LifeStrategy. There are 5 versions of this fund available, where the number on the end corresponds to the fixed percentage of equities it holds. For example, Vanguard LifeStrategy 80 holds 80% equities and 20% bonds. Hsbc Global Strategy portfolios, like Vanguard, have 5 versions going from cautious, which holds largely bonds, to adventurous, which holds largely equities. Unlike Vanguard, these allocations aren't fixed and can change over time. For example, the Hsbc Global Strategy Balanced Fund can allocate any amount from 40% to 70% in equities, depending on the manager's market view. BlackRock Consensus Funds also have 5 versions, where the number on the end corresponds to the maximum percentage of equities it can hold. Like Hsbc, these allocations aren't fixed and can change over time. For example, BlackRock Consensus 85 can allocate any amount from 40% to 85% in equities, depending on the manager's market view. So, how do you choose between multi-asset funds? The most obvious thing to look at is cost. All of Vanguard's offerings charge 0.22%, Hsbc charges between 0.18% and 0.23%, with the more expensive versions holding more equities, and all of BlackRock's offerings charge 0.21%. So far, so similar. In terms of allocations, of the 3 discussed here, only Vanguard LifeStrategy offers stable asset allocations you can be sure they'll stick to. There's ample evidence to show active management does not pay off for most people. See part of my video on index funds versus individual stocks for a discussion of active versus passive funds. Another thing to consider is the type of bonds the funds hold. Unhedged global bonds and corporate bonds all add extra diversification and risk to your portfolio. The point of bonds for our purposes is to be a refuge in a crisis, not an extra source of risk. We discussed bonds in my first asset classes video. The bonds that best serve this goal are UK government bonds or highly rated foreign government bonds that are hedged back to the pound. All 3 funds contain some corporate bonds, but only Vanguard doesn't contain unhedged global bonds. A final, maybe less important factor is that the Vanguard and Hsbc options contain emerging market equities, but the BlackRock option does not. Containing emerging markets generally means they'll be more representative of the global equities market. As mentioned in a previous video, emerging markets generally offer higher returns at the cost of higher volatility compared to developed markets. For these reasons, in my opinion, Vanguard is the best multi-asset fund. But any of these three options will serve new investors well. There are also other options not discussed here from Fidelity, Legal & General, and AJ Bell. Once you've decided which multi-asset fund family to choose, the next decision is which one within that family. As mentioned previously, this will come down to what's known as your risk tolerance, which is a very important factor in investing, regardless of strategy. As mentioned in my first video on asset classes, generally, equities deliver higher returns over the medium to long term than bonds, and indeed property and other assets, but at the expense of higher volatility, which is the sharpness of rises and falls in the short term. The lower your risk tolerance, the greater your propensity will be to sell when the market falls, which damages long-term investment returns. Therefore, in general, the higher your risk tolerance, the higher your equity exposure should be, as you'll be less likely to sell during major crashes that normally hit equities the hardest. There are various questionnaires you can take online to estimate your personal risk tolerance. Be aware though that these are just estimates, and it can be difficult to predict what your reaction would be to different circumstances in practice. If you find out when you experience your first market correction or crash that you got your risk tolerance wrong, you can always readjust your portfolio accordingly. As well as your own personal risk tolerance, in general, young people are able to take on greater risks than older people, since they have a longer time period ahead of them to recover any short-term losses. Therefore, you may start out with a high equity exposure initially and reduce it over time. One final thing to note about the Vanguard and BlackRock funds is that they have what's called a home bias, which means they hold a greater percentage of UK assets compared to the actual global market cap of UK assets. The UK is less than 5% of the global stock market, whereas these funds hold significantly more than this. Having a home bias can leave you overly exposed to your home market, particularly when you consider this is normally where you live and are employed, and hence paid in your local currency. However, in my opinion, this isn't too much of a problem with the percentages we're talking about here. It's more of a problem if you only invest in your home market and don't get any international exposure at all. So in conclusion, multi-asset funds are very low cost and give good returns through what's called diversification, which is investing in a broad set of companies, industries, and countries. You achieve close to average market return and actually beat most active investors who try to beat the market by picking certain stocks over others. In upcoming videos, we'll discuss various different investment portfolios which may offer better returns at the cost of increased complexity. Thank you so much for watching. I really appreciate it. Please add your own thoughts and follow-up questions in the comments, and I'll try to get through as many as I can. If you made it to the very end, please destroy the like and subscribe buttons and notification bell so you never miss a chance for more money making.